Hello, this is John Llodra. I'm a founder and partner here at New Harbor Financial Group for our weekly market update. The purpose of this is to bring some data and insights and really further the purpose of why we're here to help our clients and viewers make sense of these markets and hopefully grow and protect their hard-earned financial assets. Here we are, Thursday, March 14th of 2024, and we're just barely off the all-time highs in the S&P 500. And what I'd like to do with today's video is talk about some recent developments underneath the surface that are starting to speak to some slowing, we think, and possibly a faltering of this blistering move higher that started at the end of October of last year, end of October 2023. And I've got a bunch of charts I'd like to step through to illustrate that. I'm going to lean heavily on some charts today, less on my face, and really because I want to focus on some data and hopefully draw some insights from that data and less about my opinions or feelings about things. So last year, 2023, was a strong up year in the market, and the headlines, of course, were all about the Magnificent Seven and some of the meme stocks, the AI stocks. And if you look at the Magnificent Seven, I'm not going to name those names because we all know what they are, and we'll see those names in just a moment. But they were up vastly higher or more last year than, for example, the average stock, whether you look at the S&P 500 as a whole or without those 7 stocks included, or even the equal weight S&P 500, basically neutering the weight of these huge mega cap stocks. This year, however, we're starting to see a fracturing. We're starting to see some of those very strong performers start to skip a beat, maybe falter, and maybe even stumble. And these are very notable developments if history's any guide. I'd like to show a little bit about what's going on there and draw some perhaps inferences about what this means for the near-term direction of markets. Of course, there's no guarantees. We take in data to form our impressions about probabilities and likelihoods of upside versus downside. So without further ado, I'm going to share my screen. And what you see here is, whereas all these 7 stocks, you all know these names, whereas last year they were all soundly up higher, quite a bit higher than the S&P 500. You have a couple of these that have started to falter, most notably Tesla. It's off almost 35% year to date. Apple, our beloved Apple, can do no wrong. Apple, everybody owns Apple stuff, right? That's off over 10%. Google's barely up. In fact, just a handful of days ago, it was down on the year. The S&P 500, this is the capitalization-weighted S&P 500, the one that is most often cited, was up about 8%. And then you had, these stocks. Of course, Nvidia, being the poster child for the AI hype and revolution, is up a whopping 77+%. So again, what I want to call out here is that some of these stocks are starting to falter. The analogy is oftentimes used in a battle. When the generals start to falter, it's a sign that perhaps the tide of war, tide of the battle is likely shifting, and that's something to be very notable here. I want to zoom in on one specific sector, the semiconductor sector. This happens to be the sector that Nvidia is in. Nvidia manufactures and produces a special kind of microchip called a GPU. It's short for graphical processing unit. And interestingly enough, I first knew about Nvidia because my son many years ago bought a video game, and it exceeded the graphics capability of our computer. So I had to buy this super duper graphical chip, and it happened to be Nvidia. I had no idea what that company was at the time, but it was necessary to run the graphics of this computer game. Well, it turns out that the technology in these GPU units also, because they are able to separate calculational tasks in parallel, basically, rather than in traditional ways that traditional microchips do, they happen to be a very powerful chip in the immense calculations and computing power needed for AI type applications. Well, anyways, what this chart shows is the volume of options on semiconductor stocks year to date. And they're up over 445% above this time last year. And you can see massive increase in the volume. This in a snapshot is indicative, very symbolic or emblematic of a lot of speculative activity in the sector, frankly. And that is a really massive run-up that we think bears some real close watching. This next chart looks at basically a ratio of the 200-day returns of the SMH, this is a semiconductor sector ETF, relative to a broad technology sector ETF, XLK. And each of these, and this goes back to 2001, each of these peaks are noted here. And who knows if where we are right now ends up being a peak. It certainly could reverse any day now. But what this chart, and this is courtesy of NASDAQ Dorsey Wright, it's a technical dashboard that we have used at our firm for many years. It basically shows the subsequent returns when this kind of ratio peaks. And what you see here is, on average, the 1 month subsequent returns from these peaks are negative, especially for the semiconductor sector, snapping back to more average sector type of returns. And then you go out 3, 6, 12 months. I'm going to focus on the 12 months for a second. You can see in 2001, that was a tech bubble, of course. A year later, these were both the semiconductor sector and the technology broad sector were down tremendously 12 months later off of that peak. And same for 2002. Of course, that was a tech bubble. The NASDAQ was down over 80% in that ultimate collapse. But then there were other years, like, for example, 2013, where the returns were up positive. The average, you can see, looks fairly benign. This is an example of, there's a saying that an analysis of averages can lead to average analysis. And I think there's more than meets the eye here. And most notably are things like the speculative behavior I just talked about there in the options purchasing and valuations that I think probably in our minds likens the current scenario probably closer to a scenario of 2001, 2002 than, for example, 2013. We don't know this for sure, obviously, it's an unknown, but there's a couple data points I wanted to share just to kind of give you a sense for our leanings here, that this probably is closer to a blow off top than a pause that will continue on with strong further gains from here. I want to zoom in on the chart for Nvidia for a couple reasons. So this is just a daily chart going back a year, and you can see Nvidia has so far this year taken off. This trajectory is after a flatlining here for much of the last half of last year. We've had a very sharp bounce here, and I want to point this out because this lower pane shows what's called the relative strength index, and this is a measure of extremities. Simply, when the RSI gets above 70, which is this line, it's classically a sign that things are overbought and likely to pull back. Now, I emphasize likely because there's no guarantees. In fact, you can see here the RSI for Nvidia stayed well above 70 for a long time. A little dip here, but right here. And it wasn't until just recently that it pulled back below that. And that's all to say that sometimes when things get overbought, they can just become more overbought. So we're very careful not to rely too heavily on one thing as to indicating a pause in the market. RSI can be a very useful tool, but there are times where RSI can just get more extreme, and meanwhile the upward move in the prices continues. And this next chart speaks to that very same thing. And this is file this under who would have thunk, right? This shows the RSI for the broader S&P 500, and what it shows is it breaks up the RSI. Basically, out here is when it becomes more overbought. Down here is when it gets more oversold. These are split into 20 quantiles, which are 20 buckets of 5% bins, if you will. And interestingly, what you notice is that, not surprisingly, the returns over the subsequent 12 months are strongest when things are really oversold, meaning they got so thrown out with the bathwater that a bounce higher is very likely. But interestingly, some of the very highest RSI readings have also led to some of the highest returns. So that's just another picture of looking at sometimes things can get overbought and become more so. And frankly, that's one of the reasons that we have been so reluctantly more invested in stocks than we otherwise would have wanted to most of this year, and frankly, the last handful of months. Valuations are obscene, but some of the technical indicators we follow in concert with one another has convinced us that things were going to run quite a bit further than fundamentals would justify. So let's continue on here. This is a look at what's called the option skew for Nvidia. And this is another, again, I showed you that other chart about the options activity in the semiconductor sector. This is a picture of that for NVIDIA, and it shows basically the option skew. And basically when the line turns down here and reaches low points, it's showing that the bullishness in terms of call buying is much more pronounced than the bearishness of put buying. And it's, again, just another contrarian indicator of ultra bullishness, ultra speculation, ultra sentiment frenzy in favor of things like, in this case, NVIDIA. It's generally a kind of an ominous sign when things get this frothy, if you will. And I want to turn to that to look at the recent price action of the semiconductor sector. This is SMH, that's that VanEck Semiconductor ETF. This is not an investment recommendation, of course. I just want to use this as an illustration. And I want to call out, so here's today's action. But earlier this week, I think this was on Monday, I believe, Monday or Tuesday this week, we saw this day right here. What this is, see this massive reversal. Each one of these bars represents the range within a day. And what you see here is a range that fully engulfs the prior very strong up day. This is what is called a bearish engulfing candle. And it's really, really a concerning technical picture. And when you look at the volume in this lower pane, this is the volume traded in that particular security. You can see the volume that day was off the charts. That move, that huge reversal, intraday reversal, combined with the huge volume, is quite a concerning picture. And this could be the canary in the coal mine that is further showing that some of these really strong stocks that have gotten way ahead of themselves, in our opinion, and we do think NVIDIA has gotten way ahead of itself. This is SMH. I'll turn to NVIDIA in a second. This is a very concerning picture. We think could portend pause in the market here, and we'll be watching that very closely. All of course, to encourage folks to tighten defenses and things like that. This is the chart for NVIDIA itself, and same kind of thing. You see this bearish engulfing candle, again on huge volume, and there was a knee-jerk reflexive bounce 2 days later on weaker volume, and we had another down day today, again, Thursday, March 14th. Starting to see some of these ominous signs, and I wanted to kind of bring this next chart up. It's courtesy of Apollo, just to, again, reassert the backdrop, the fundamental backdrop that lean us towards this being more like kind of the action of the tech bubble versus just a pause. I showed that chart a few pages back of kind of the ratio of the semiconductor index to the technology index. And what this shows, it basically shows the PE ratios for the percentage of stocks within the S&P. So for example, you look at each one of these bars, the darker one is March of 2024, and the lighter one is the 1990s tech bubble. You can see basically for pretty much every percentile here, except for maybe the real low ones, and these are the lower valued stocks. The PEs today are higher, in many cases vastly higher, especially in this bracket right here, than they were in the tech bubble. This is all to say that some of these technical warning signs have got us really concerned because of the backdrop of the ultra high valuations in the market. And we have taken some recent actions to make our client accounts more defensive. We've taken some equity exposure off. We've adjusted our hedges, and we're very vigilantly watching for how this follows through in the coming days and weeks. But we're suffice it to say, our radars are up. We're not hitting the panic button quite yet, but we do think there is heightened reason to be concerned and batten down the hatches, so to speak. So let's switch quickly to the other major news of this week. Today, another inflation reading was published, the PPI, Producer Price Index. This is a measure of input prices to manufacturers and producers. And the simple thinking is that as costs go into manufacturers, if those costs are rising, the tendency is for those manufacturers to try to or have to push those prices off to consumers, and therefore having a daisy chain effect to raise consumer prices. Well, the last several CPI, Consumer Price Index reports, we can be categorized as somewhat hot, meaning higher than expected, or perhaps at least not as soft as expected. It seems pretty convincingly by the CPI numbers of recent days and weeks that the pace at which inflation is pulling back is not only slowing, but it's evident that there are certain parts of it that are becoming quite sticky and concerning. Well, today's PPI report was hot. It came out higher than expected almost across the board. And so this is adding fuel to the fire that there's concerns about inflation being stickier than the market and the Fed perhaps has thought. And probably the best way to see the market take on this is to look at the expectations for interest rates, Fed rate policy. Starting at the end of October of last year, the market and the Fed, both in unison, did a pivot of sorts and became ultra confident. The market, anyways, became ultra confident that the Fed was going to drop interest rates in 2024, and that they were going to start early in 2024, and they were going to drop as much as 1.75 to 2% throughout the course of 2024. The Fed was much more cautious about telegraphing their plans. They projected at the time that maybe 3 interest rate cuts and maybe a total of 0.75% of cuts. But since that time, these inflation readings have come in quite a bit hotter, and there's been a pretty dramatic repricing of probabilities by the market of those interest rates. So let me show you what that looks like. What this is focusing on the May meeting, the May Federal Reserve meeting. Again, a couple months from now. Here we are in March. We're very close to the March meeting. But for all intents and purposes, the March meeting, no one on this planet thinks the Fed is going to cut interest rates from the current 5.25 to 5.5 target range. And interesting, at the end of last year, there was about an 88% market implied probability the Fed would cut at least once by the March meeting. So essentially from 88% the end of last year to 0 now. Pretty dramatic shift in odds in terms of a rate cut at the March meeting. But this chart is for the May meeting. And what this shows is the probability that rates would stay at the current 5.25 to 5.5% range. And you can see here, again, this is the probability that it would stay at the current rate. Starting late last year, the market got to essentially a 0 probability that the rates would have stayed, would stay at the current levels by May. In other words, 100% chance of a cut by May. Now you see here, we have rocketed higher. To right now, there's an 88.65% market implied probability that the current range will still be in place in May. So only a 12% or so probability of a cut by May. It's a dramatic repricing from, again, essentially 0 at the end of last year to 88% chance of staying static at the May meeting. Let's look at the June meeting. For much of late last year into this year, essentially there was a 0% market assumption that the Fed wouldn't have cut by June. Now that probability is only 35%, so only about a 65% chance of a cut. So these are pretty dramatic changes here. We think the stock market is yet to price that in, but bond markets are certainly have been pricing that in. The 10-year yield today on the hot PPI report shot back up to 4.3%. We think it's still a bit early to be dipping back into longer-term bonds. We have a very small allocation to long-term treasuries, about 5 to 10%, depending on our client situation. We'd probably be looking to add modestly to that if rates, 10-year treasury yields get back up towards 4.5% or so, but we're in no rush to do that. We think there is pressures here that aren't fully priced into the bond market nor the stock market. And bottom line is, we think the situation is this soft landing that has been professed or talked about for months. We think is rather much a pipe dream. I think just today the retail sales came in really soft. Our base case assumption is that if and when the Fed does start to cut, it's not going to be because things are peaches and cream, but it's probably going to be in response to a pretty dramatic slowdown in the economy or a very sudden pullback in markets. And we'll just have to wait and see. But we think there's a powder keg here that is waiting to be lit, and we just urge caution. Don't run for the hills quite yet, but batten down the hatches, tighten your hedges, de-risk. Don't be taking a lot of risk here. We don't think being heavily invested in stocks right now makes sense. We're still getting very attractive short-term yields on short-term treasuries, treasury bills, things like that, ultra safe, ultra liquid, and paying you to wait for better opportunities. But I hope you found some of these charts helpful. We certainly look at these and a whole bunch of other data as we navigate these markets on a day-to-day basis, and we invite your calls, your questions, and we encourage you to follow our channel here. We put out content every week, and we hope to educate and help folks make informed decisions. And I just want to thank you for watching, and until next time, I wish you a great day.